Fibonacci levels and trailing stops. Kindly read through this page now and again after the session has concluded. I'll be covering the points in the course of the session. Now, let's just take this hypothetical scenario, and this is a Euro 15-minute chart. We see here how we have the price has been dealing within these ranges. It has moved out above and then has come back down to test the low of these ranges. And we see a couple of spikes down here. To put things in perspective, it's only 4 pips between here and here is only 4 pips. These are about 6 or 7 pips spikes down. Let's just assume in this hypothetical scenario that this is a key level. This is an established key level as it's been established based on price action in history. And we decide that should this low hold and price break through this trend line and hold above these dealing highs here, then that we would want to enter long. And we would place, if we bought here at 120.65, of course we would buy it on the pullback. But if we buy here at 120.65 and place our stop down here at 120.45, we'd have a 20 pip stop. And here we are anticipating that price will make another leg up since this low was rejected. That price will make another leg up, and we want to get a feeling for how we can manage our stop. Here's our 120.65 level right here. This is at or about where we entered the trade. Here's our downtrend line. Price failed to move lower. It moved upwards. We started dealing above these ranges. Our next target was to deal above these ranges right here. And price moved over the period of the next hour or so. It moved up and created a high, and we actually took we sold 3 lots at 120.94 for a first profit of 25 pips. Just stepping back here so you know where I get the 25 pips from. We bought here at 120.65 bid. Okay, so it would be 68.69 on the ask. So just thought I'd clarify that for you numbers people out there, for you accountants and engineers. Anyway, you just got to work with me. We have to be flexible with this. All right. Just like we do the market, because if you're rigid in your thinking, then the market can be a very dangerous place for you. You don't want to be so focused on the micro numericals. Rather, you want to look at the concepts that we're trying to portray in this exercise. So, okay. In any event, don't get me wrong. I have a great deal of respect for accountants and engineers. You know why? Because I could never be one myself, because I'm not smart enough. In any event, here's our high, and we see price move above, forms a high, and the idea is to take first profit at target objectives that may lie up here based on clearly established levels on support and resistance, Fibonacci extensions, even price projections if you're using price projections, Steve Nissen price projections, and so forth. Tom DeMark price projections, whatever ones you decide. I like support and resistance because they are clearly delineated. The line is drawn in the sand based on previous dealings, so I like to deal within those ranges. In any event, what we do now is from this low, the initial low where price started to move, and the newly established high, once you see a couple of candlesticks form on either side, you simply pull your Fibonacci up to the highest high Then we have our retracement values offering invisible levels of support to the market. And we can choose whichever one we want, but when we first started, our stop was down here 20 pips below our entry. So if price came all the way down and stopped us out, we would lose 20 pips. Now that we have taken first profit on some 3 lots out of, I believe we started with 5, we've taken profit on 3 lots, and now we move our protective stop up. It's actually just below entry the way it works out if we want to remain below the 62% retracement level as an area of protection. Alternatively, we could be a little bit more risky and place our stop below what is the 38% retracement, as well as the previous level of resistance, which now offers support. So we could put our stop up here a little closer, maybe about 7 to 10 pips closer to the market, remaining protected by this level of support. Our previous high, where we had our Fibonacci's pulled, was from this low to this high, and our protective stop was down at around 120.65. And we've seen price retrace almost to the level of resistance and then make another leg up on the day. Again, we're looking at a 15-minute chart, so this is entirely intraday price action. Now what we do is we take our Fibonacci's and we pull it from this low all the way to the newly established high to see where our new levels of support may lie. So number one, we have this level of resistance that becomes support. We have a 38 retracement, 50, 62, 79, and we can move our stop if we like. We can keep our stop below the 62% retracement, or you can choose to put it below the 38% retracement and this level of support. Meanwhile, we take another lot out at 45 pips. That leaves us with 1 lot left out of an original 5 lots. And the reason why we want to have 1 lot left, which is 20% of our position, is price could come down here, find support here, and then continue to move up another 50 or more pips. If the position carries into the following day, we could move another 100, 200 pips on that 20% remaining in our position. So whether you're trading 5 lots or 50 lots, the principle is the same. Now, this is only one scenario of a multitude of scenarios that will unfold, and you have to realize that every scenario will look different, but I just want you to understand the concepts here before when you go to apply it in your own trading protocol. Our previous high was here, and now we take our Fibonacci and we pull it from this low up to the new high up here. Price has hit the 127% extension of this swing, but now we pull the Fibonacci to the new high, and so we're at this low to this high, and the 38% retracement lies at approximately 121.10. Our resistance, which is now support, is at approximately 121.15, and of course we've got our 50 and 62 and 79. We're also getting late in the session now, so we are likely to see some consolidation drift down here to this level of support, resistance support, and the 38% retracement. So you can choose to do a couple of things with the last 20% of your position. Is you can move your stop below the 38% retracement, the 62, or you can even keep it below your original low. And consider in your equity management that price may come all the way back down and stop you out. This is what it looks like in the larger spectrum. We can have our Fibonacci pulled from this low to this high, or we can have it pulled from even one of these lows to the high. In any event, as price consolidates, we find it supported at the 38% retracement from this low to this high. And if price now comes down and penetrates the 38% retracement, then we are out of the remaining percentage of our position we have to, if you want, it's very risky putting your stop this close. You could have a trailing stop below the 62, or you could have it well below, as I've already mentioned. Well, what happens here now is you see this date change here. We change into a new day here at 0 hours GMT. You can't see it on the screen here, but you can see it in your books. 0 hours GMT is here, and then Asia fails to make a new high. It attempts but fails to make a new high during the Asian session, which is a characteristic that I've noted and that has been observed in these lessons. And price comes down, and as liquidity picks up during the London session and Central European session, the market decides to take price down below this 38% retracement and stops us out. But we got stopped out for 50 pips on the final lot, or on the final 20% of the position. So that's just a basic concept as to how you can trail your stops using Fibonacci's on an intraday basis. But to do it then on a medium or longer term basis, you simply would use the larger swings and use your Fibonacci tool on the larger swings on 1 hour charts, 4 hour charts, and so forth for your position trades. And I'll even use it on daily charts.